Imagine you're making an important investment decision, a decision that could change your financial future. But as you look at the numbers, something feels off. Your gut is telling you one thing, but your brain is telling you another. This conflict between logic and emotion happens to all of us. It's how we make financial decisions, often irrationally, yet predictably. Today, we're going to dive deep into a fascinating field of study called behavioral finance, the psychology that explains how emotions, biases, and social factors shape the way we manage money. Before we get into the nuts and bolts, hit that subscribe button if you haven't already, and let's grow this community together. I'm aiming for 1,000 subscribers, and your support makes all the difference in bringing more insightful content to your screen. Now, let's break down how our brains influence financial decisions, often in ways we don't even realize. Cognitive biases in financial decision-making. Let's begin by exploring the mental shortcuts, cognitive biases, that influence how we make financial choices. A cognitive bias is a systematic error in thinking that affects decisions and judgment. These biases distort our judgment, often leading us to make irrational financial decisions. Confirmation bias is one of the most common biases we encounter. It's when we selectively search for, interpret, and remember information that confirms what we already believe. For instance, if you're an investor in a certain stock, you'll likely only focus on the good news and ignore any signs of trouble. If you've ever invested in a stock and heard rumors of potential failure, but you dismissed them because they didn't match your view, you've experienced confirmation bias. Another powerful bias is anchoring. This bias occurs when we give disproportionate weight to the first piece of information we encounter. Imagine you hear that a stock is worth $100. This anchor becomes a reference point, and when you see the stock drop to $95, you might hold on to it, thinking it will return to $100, even though market conditions may have changed. You've anchored your decision on that initial price. We also need to consider availability bias, where we make decisions based on information that is most readily available to us. For example, if we see headlines about a major financial collapse, we might start to believe that the market is always on the verge of a crash, even if statistically, the market is doing fine overall. Emotional factors in financial decisions. Now let's turn to the emotions that drive our financial decisions. These aren't always rational. In fact, they can often be the opposite, but understanding how emotions play a role can help us navigate the complexities of financial choices. Fear is one of the most powerful emotions affecting investment decisions. Fear of loss can lead to loss aversion, the tendency to fear losses more than equivalent gains. Imagine a situation where an investor holds onto a losing stock because they fear selling it at a loss. This can lead to irrational decision-making, where you hang on to an investment too long, hoping it will rebound, even though market indicators suggest it won't. On the other hand, we also have greed, a powerful motivator during market booms. Investors who fall prey to greed often chase after investments with unrealistic expectations. Think of the cryptocurrency boom or the dot-com bubble. Greed drove people to make high-risk investments, hoping to achieve extraordinary returns. But when the bubble bursts, the results can be catastrophic. Overconfidence is another emotion that can lead us astray. When investors believe they have superior knowledge or skills, they tend to take excessive risks, overestimate their ability to predict the market, and engage in overtrading. This leads to significant losses because they ignore the unpredictable nature of markets. Herd mentality and social influence. Let's move on to social influences. Human beings are social creatures, and we often look to others for guidance, especially in uncertain situations. This is where herd mentality comes into play. We tend to follow the crowd, assuming that if everyone is doing something, it must be the right thing to do. In finance, this plays out in the form of market bubbles. Take the housing market crash of 2008. Many people bought homes they couldn't afford simply because everyone else was doing it. Even if the fundamentals didn't support the housing prices, the herd mentality pushed them higher. This leads to asset bubbles, where the price of assets like housing or stocks are artificially inflated, only to crash when reality sets in. Similarly, Social proof influences us. If we see others around us making financial decisions, whether it's investing in a hot new stock or buying real estate, we're more likely to follow suit, even if it's not in our best interest. It's a psychological shortcut that makes us feel safer, but in reality, it can lead to poor financial choices. Overcoming behavioral biases and emotional traps. Understanding the psychological traps we fall into is the first step to overcoming them. The next question is, how can we fight these biases and emotions to make better financial decisions? Awareness is key. The more we understand the biases and emotional factors that drive our decisions, the more we can counteract them. For example, if you're aware of your confirmation bias, you can consciously seek out information that challenges your views. Or, if you know that you tend to hold on to losing investments due to loss aversion, you can set predetermined rules for when to sell an asset, regardless of your emotions. Diversification is also a key strategy. By spreading your investments across different asset classes and sectors, you reduce the risk of making decisions based on emotion. Instead of focusing on a single asset, you'll be more likely to make data-driven, rational decisions. Another strategy is automating your investments. By setting up automatic contributions to retirement accounts or other investments, you remove the emotional temptation to time the market or make impulsive decisions. Practical applications of behavioral finance. Now, let's look at some practical ways to apply behavioral finance in your life. Whether you're an investor, a consumer, or a business owner, understanding these principles can help you make better financial decisions. First, as an investor, don't try to time the market. Research shows that attempting to time market highs and lows is a fool's errand. Instead, focus on long-term goals and stick to a disciplined investment strategy, even when emotions tempt you to do otherwise. As a consumer, understand that emotional spending can be a trap. Whether it's buying the latest gadgets or making impulse purchases, emotions can drive you to overspend. Recognize these patterns and create a budget that prioritizes needs over wants. And for business owners, understanding behavioral economics can help you better navigate pricing strategies, marketing techniques, and consumer decision-making. Whether you're trying to set up your product pricing or crafting a marketing campaign, applying behavioral finance principles can give you a competitive edge. Behavioral finance shows us that we're not always the rational, data-driven beings we like to think we are. Our emotions, cognitive biases, and social influences shape our financial decisions in ways that can be both helpful and harmful. By understanding these psychological factors, we can take steps to make more informed and rational decisions with our money. Thanks for watching. If you found this video insightful, make sure to subscribe and join me in future discussions where we dive deeper into the world of finance, psychology, and the economy. Let's continue exploring how we can make smarter financial decisions together.